Time for today's Tech Check, and let's get to Deirdre Bosa in San Francisco. Hi, Dee.
Hey, guys. Well, rising interest rates and the macroeconomic concerns, they've made for a tricky buyout and financing environment, but the exception remains software. You've got SailPoint, Anaplan, Coupa, Avalara, all take private deals worth $7 billion and up. Here's Orlando Bravo, one of the most active private equity buyers this year, on the opportunity that he sees.
These multiples of revenues have gone from 17 times on average at the peak to about 4 now. Now, what that does is it's much more important than valuation. Is what it does is it produces an environment where some of the highest quality, largest software companies are looking to go private.
So the latest deal could be for digital survey software company Qualtrics. It is fielding a $12.4 billion bid from private equity group Silver Lake and Canada's largest pension fund, and it would represent one of the biggest buyouts of the year. The price, $18.15 per share. That is a 6% premium over last Friday's closing price, but it's a 40% discount from its 52-week high. And therein lies the opportunity for private equity buyers, what Bravo was alluding to. Software and cloud valuations, they have, of course, reset from the pandemic or from their 2021 peaks. And management and boards, they may now be more willing to accept that lower valuation. Qualtrics, though, also represents a risk. Now, before it was set to go public back in 2018, SAP swooped in with an $8 billion acquisition offer. The idea here was that Qualtrics' customer and user data would give SAP a huge leg up on competition. That didn't happen, though, and Qualtrics was spun out in an IPO. Now SAP, with the remaining 71% stake in the company, it stands to make about 10% return. That's fine, but it's nothing to write home about, and it really wasn't the game-changing deal that it was once thought to be. Silver Lake may have more luck. In terms of the next take-private software targets, well, Morgan Stanley did a screener a few months back, and they looked for about $5 billion in enterprise value or less, large enterprise customer base, 75% plus subscription revenue, 80% subscription gross margin, and 90% plus gross dollar retention rate. When you screen for those top candidates, they included PagerDuty, JFrog, HashiCorp, and Smartsheet. And on the private equity side, guys, we know that there is a lot of dry gunpowder, a lot of money that they have to continue to do these deals. Aside from where interest rates are going, you're seeing more all-cash deals happen as well.
Yeah, and not just in tech. There was it maybe Arconic? I saw a similar sort of scuttlebutt about recently. But Deirdre, as you mentioned, not a great return for SAP here, but pretty terrible position for the rest of the public investors in Qualtrics. I mean, you're talking about the company getting taken out at barely a 5% premium. With this. Now, maybe you could say, look, it's their fault. They went into this eyes wide open, knowing it was basically controlled by SAP. But that's such a terrible premium. They come in when it's at a low value. I guess it just speaks to the desperation some of these investors and companies have right now.
It's a difficult market moment, right? During 2021, they saw a lot of these software companies run up so much. I mean, for Qualtrics, it was at $30. Now you're accepting $18 and change. That is, however, better than where it was a few months ago. So this is the constant dilemma when you're looking at private equity groups and whether they want to take these companies private. They think that they might be getting a good deal now, but you have founders and CEOs on the software side saying, hold on a second, our stock was worth 80% more just a year ago. Maybe we can get back there. So there's that dislocation, but it's starting to come more in line, especially the higher that interest rates go, which makes their future earnings less valuable, and the market volatility that we've seen.
All right. Thank you, Deirdre.